Yeah, so, I think broadly, when we look at your portfolios, I would say that there is a lot of defensive exposure in there. So we are overweight healthcare. We also have exposures to things like Brambles and Amcor, which is basically moving around consumer goods. So those sort of businesses have held up particularly well through this challenging economic climate. I think as we look forward, it feels like we now move into the recovery phase. And so under that sort of environment, you would typically think that other businesses will benefit from that. So what you will probably see happening in portfolios over the next sort of 3 months, 6 months, is that we slowly move in some of these companies that are more leveraged to that cyclical recovery. So things like Macquarie Bank, things like Cuba Logistics, which owns Patrick Stevedoring business, and they have a huge property development going on up here. So businesses like that will be obviously benefiting from a recovery in the economy. I think, Jay, you'd mentioned, I guess, airline stocks and gold. So just to cover off on those, I think Sydney airports could be very interesting at some point. So it's a phenomenal asset. The concession runs, I think, until 2099. Certainly there's a long time to go. It has also been a beneficiary of this low interest rate environment, which we'll touch on, I'm sure, in a minute. So that's all good. The only question is what the timing is of, in particular, international travel. But I could envisage a situation where we do start buying Sydney airports at some stage over the next sort of 3 to 6 months. I think certainly if we start to get a strong conviction that a vaccine is coming and international travel will be coming through in the next 12 months, then that's an obvious one. Gold, I think.
Hamish, just back to the aviation, just quickly, with like in terms of your decision-making process about, say, in the aviation sector, your decision-making around which make the cut for you in your model portfolios. I know there's obviously the universe is fairly broad, but how do you see that, or what's your decision-making process in what makes the cut for you guys with your model portfolios in that sector specifically, or any sector?
For sure. So, I mean, I think if you look at airlines generally, now Qantas in Australia is probably one of the best airlines in the world, but airlines as an industry is very competitive and I would say very difficult. So ideally, we would rather not own that. And then what you're left with within Australia is kind of the airports, or there's also the Auckland International Airport, which is also another great asset, but you're quite limited. When we've had discussions about Boeing, if you're looking overseas, then, the actual, g'day Peter.
Morning, how are you?
Yeah, so going overseas, you then have a greater selection of businesses. So the aircraft manufacturers, Boeing and Airbus, that's a solid duopoly industry. So it's interesting. Prices of those have been decimated, but I think Sydney Airport is a monopoly asset, albeit there is going to be another airport that will come into Sydney, in the next probably 5 years. But to me, it just seems like an obvious one where you have a quality asset that's underpinning you, regardless of sort of what happens in the competitive dynamics of the overall industry.
Could you see the includes, obviously, because the universe outside of Australia is much greater, and I know that this isn't available to all of our clients in terms of access to the international assets. It's a little bit more difficult in some of our platforms, but is the inclusion of some of those international aviation assets something that you'd consider in the future, or is it you feel as though it's too?
Yeah, potentially for the, obviously for the SMSF accounts where we can buy the direct international, albeit I would consider those less core. So really for clients wanting to own direct international positions, the core companies that I first like seeing in portfolios are things like Visa, Google, or Alphabet as it's called. So these, you know, really solid businesses that sort of have incredibly strong market positions. So they would be the first things that I would want to see in there before you would sort of start looking at, you know, those aviation type plays.
I think you probably answered this so many times in these calls with us, and you know, we have those clients that will have specific stock that they'll have questions about, and they might be ones that maybe, because the universe of stock's pretty large, they're not ones that you have the ability to be over the top of. And I think that, again, maybe just explaining for our clients that because the universe of stock is so large, that your attention to the model portfolio and the things that make up that model portfolio is fairly all-consuming. So the stocks outside of that's very hard to be over the top of all of them. I think I threw one at you, which was Mesoblast, which you said to me, listen, I really don't have a handle on the technology and the IP behind it. But
that's it. It's you know, we cannot be across everything, and there is, you know, to use Mesoblast as an example, it's developing, you know, very complex technologies that I have no experience around. And I mean, I think to use Buffett's example, he only wants to buy, he refuses to buy anything other than something that he clearly understands. And I think generally that's a really good discipline. It's hard in my role because I get asked all the time about lots of companies, and you feel like you should be giving an opinion, but the reality is this: you just cannot be across everything. So I try to sort of stick to businesses that I can understand.
Yeah, and I've also, again, this is sort of an interesting segue, well, at least for me it is, and maybe for clients, just understanding why it's not that easy to give a definitive opinion or a definitive answer on particular stock, because like the financial planning industry, the broking industry has undergone an enormous amount of change in compliance, and we are all bound very much by the advice that we give, you know, and implied advice versus actual advice. And again, I know, Hamish, because your world's changed in terms of compliance a lot, and the need to provide disclosure and statements of advice. It's not as easy as it maybe once was to flick a message or a recommendation to someone to say, yeah, you should buy this. It requires some deep insight, and which I think, again, a long-winded way brings us back to why a core model portfolio that's managed intimately is so valuable to clients. You know, that model portfolio construction that's got some real basis and thought behind it is so important, as opposed to maybe some of those emotional reactive decisions that people make because they've got a hot tip. Well, sort of like the Melbourne Cup, you got a hot tip, we'll jump on, and the success rate of those, which again I think was spoken a lot about in the past, sort of survivorship bias really leads the vocal minority saying, yeah, I did fantastically out of that speculative stock, whereas the majority generally don't. And history suggests that playing the long game in sort of Buffett style, making sure we understand what we're investing in and holding it good quality stock for a long period of time is in fact the right long game in most instances.
Absolutely. Absolutely.
The thought that perhaps we can win Taxono with one of these ones that come out of the blue that no one knows about, we've heard about, and we can grab a piece of it and it'll be 100 times more in a couple of years' time than it is today. I think the conversations often that I'll have with clients when they talk about those spec stocks is, if you want to gamble with a bit of your money, then that's fine. Like, take 5% of your portfolio or something and go and play the spec stuff if you want to. But we have an obligation, our role, and then you for us, Hamish, is to find good quality stuff that will swing around in a decade and will still be providing dividends in a decade. And no matter what shitty things we have with global pandemics or financial crises around the world, there's strong enough businesses to get through that and come out the other side still in reasonable shape. And we're trying to provide people's accumulations of wealth to provide them income through the rest of their lives when they retire. Well, you don't do that speculating. You don't win Taps Lotto to do that. That's not the game we play. And I think you providing the service for us, we need you to be really aware of all of the really good blue chip and the medium-sized companies, all the good quality stuff that's out there. If you're wasting your time, hunting around for those spec stocks, then you might as well be going to casinos all the time yourself and dealing with people that want to be in casinos all the time. That's not what we need you to do for us anyway.
Yeah, absolutely.
We'll still ask the question, though. Have you what about?
I was just about to say, but I'll still keep asking you.
That's it.
Yeah. We respect and actually accept and understand why there are lots and lots of these things that come out of the blue that you can't give us anything concrete on. And you'd be dangerous if you did. If you give us an opinion on something that's very speculative, well, you're at risk yourself, as are we and our clients.
Yeah, well, I mean, I always appreciate your honesty in saying, well, I'm not over the top of it. So here's what I know. Here's what I think I don't know, which I think is really important. I cut you off before, Hamish, as we started to venture into gold as a commodity and how it's represented in our portfolios and whether, and I suppose your general thoughts about it.
Yeah, so I might even just start with interest rates and this quantitative easing that a lot of people will be reading about. So the Reserve Bank cut interest rates further yesterday, and they've also announced this quantitative easing. So just to try and clearly explain what this quantitative easing is. So obviously they're cutting interest rates is trying to stimulate economic growth. That's cutting the short-term cash rate, the short-term interest rate. The idea with quantitative easing is to lower the long-term interest rate. So specifically, the Reserve Bank will be buying long-term Australian government bonds in the market. And as they buy those bonds, it pushes down the long-term interest rate. Now, why that's important is that everything is then priced off that long-term interest rate. So as an example, let's say the Reserve Bank cuts the cash rate from 1% down to 0.1%. If the long-term interest rate was at 2% and it remained at 2%, then that's not as stimulative. So if they can then go and buy bonds in the market to push down that long-term interest rate down to, say, 0.5%, then that's important because whether somebody's looking at buying an investment property or a blue chip company that's paying an attractive dividend yield, if they are referencing that to the long-term interest rate, then because as that long-term interest rate becomes lower, then all of those other assets become relatively more attractive, and the net effect should be that the price of all those other assets get pushed upwards. So what the Reserve Bank is trying to do is push people out of these safe defensive assets into riskier, higher returning assets, which is obviously the challenge that you're faced with. But I mean, I think, what this is, it does validate the the argument of having a well-diversified portfolio of quality businesses that can continue to generate good cash flows and pay out those cash flows ideally in the form of a dividend over time. So that's that. With gold, so I think of gold like a currency. So you can have your money sitting in Australian dollars or US dollars or gold. Gold is interesting in that these central banks can obviously print their currencies, but you can't just print gold. And where gold is perhaps somewhat more interesting today is that once upon a time, the opportunity cost of owning gold was very high because you could get, say, a 5 or 6% return owning a term deposit, whereas today you're getting very next to no return on that term deposit. So the argument becomes stronger to owning gold because the opportunity cost, obviously you don't get a yield on that gold, so the opportunity cost becomes greater. The opportunity cost is less owning gold today, and therefore the argument, is potentially there. So how investors can do that, they can simply buy an ETF that would give them exposure to the physical gold bullion. That's a very simple way. And then riskier ways are to actually own companies that produce gold and are therefore leveraged to the gold price. And that's things like Newcrest and Northern Star in Australia are sort of the big obvious names there.
Is it risky at the moment with everyone having what appears that gold price has gone up significantly in recent times, because that's where people will park their money when interest rates and when there's risk around the world? Like any other asset, is it more risky by Warren Buffett's principle of are we making a mistake if we were to buy gold now when gold is very high, or is there still, given the uncertainty around the world, is gold likely to continue to do well for a while yet?
Yeah.
Gold and gold businesses.
I mean, I think that's really, from your perspective, an asset allocation call, right? Obviously, because gold doesn't provide an income, it should never be a big component of somebody's portfolio. But sort of as a piece of insurance in a portfolio, it may have some merit for some people. But for me, I think I don't have that discussion about gold unless somebody is particularly interested in it, because I think unless they understand the nuances of it and the risks around it, it's not for everyone, in my opinion.
Hey, Hamish, I know we're running close to time, but maybe the last and most topical one in the next 24 hours is the US election. Markets I was listening this morning to CNN, and one of those were talking about 80% of times in history where the markets peak just before the election, it suggests that the in power president would hold power. So you're tipping a Trump second term, I'm assuming, based upon that, Hamish?
I won't try and speculate who's going to win. Who knows? But I mean, the one comment that I sort of thought was well said was, markets probably spend far too much time thinking about these elections, and in reality, the actual impact on the market is over time is not necessarily quantifiable. So.
Yeah, I was going to say, I think that's a really good point, and probably really reflective of any time when there's uncertainty, that we can get very caught up in the short-term emotion. And like you've said many times, Hamish, and like we say to our clients, it is very much about that long-term. And if we are making like rash decisions based upon short-term circumstances, history would suggest is generally not the right thing to do. So